It does look outwardly as if the fear of fiscal apocalypse has receded, yet perhaps what we saw was just the very tip of the iceberg. Seasoned economic weather forecasters are now peering somewhat nervously towards something called credit default swaps, a financial product that all of the big banks that have collapsed so far were up to their necks in. Alex Ritson asks what this means.
Hidden away, opaque and unseen in the world's financial capitals is one of the biggest industries of all. It's completely unregulated because until recently governments probably knew almost nothing about it. But there's a growing suspicion it's at the heart of the global financial crisis.
This is a time bomb because there's something like $60 trillion worth of insurance contracts, because that's effectively what a credit default swap is, that are out there, more than the global GDP. And we know already that around $500 billion worth of that's not going to be honoured because the banks on which the claims were written have gone bust. That's already a big enough problem. If further banks go, what was always a time bomb waiting to go off will go off in our faces.
Some people stand to make an absolute fortune out of credit default swaps. They started life as a sort of insurance policy that investors could take out, often with their bank, to protect the value of their investment if the companies that they'd put money into went down. What they turned into, though, was really gambling. People were taking out credit default swaps that effectively bet that companies were going to fail. Fine in the good time for the banks because they collected lots of money in the boom time years. But now companies have started to fail. Banks could face a truly monumental series of payouts. So, in slightly more detail, credit default swaps are a bit like insurance policies on company debt. Take any big business that wants to raise money. One way is to sell corporate bonds or IOUs. An investor buys a bond and then buys a credit default swap as insurance. The swap seller promises to pay the value of the bond if the company goes bust. It's a great way for investors, including banks, to lower their risk in the marketplace. But these days, most buyers of credit default swaps don't invest in the original companies. They just buy them in the hope the company will fail, massively magnifying the eventual cost of any corporate bankruptcy. That might sound crazy, almost like everyone in my road buying insurance on my house in the hope it collapses. But apparently it's been common practice.
Well, you know, this has been the spirit of the age over the last 5 or 10 years. You know, the credit derivatives market grew from zero almost to 60 trillion. And from a banker's point of view, they think that it creates liquidity in the market. And under the Anglo-Saxon system of law, if it's not illegal, you know, it's allowed. But I think it's legitimate for society to have a debate about whether they really want to have these kinds of banking practices or not.
And there are two British banks which have done very well out of the credit default swap bonanza of recent years. It's only by digging deep in annual reports that you discover both Barclays and RBS have total exposure of £2.4 trillion each. That's if all the swaps they've bought and sold were claimed at once, which is highly unlikely. But it's still roughly 4 times total UK government annual spending for each bank. The reason those numbers are so big is because this has been a bit like a giant pyramid scheme, with banks buying and selling credit default swaps to and from each other. But now some of their number have collapsed. Lehman Brothers, the Icelandic banks, and there have been real worries about the survival of many of the others. That means that banks could face a situation where they're paying out with one hand but unable to claim from the other party that they bought a credit default swap from. The big question now is, how do you unwind this mess?
Well, I think regulators are going to think long and hard about what to do about the credit derivatives market, and I think it's definite that we're going to move the credit derivatives market onto an exchange like we have with equities and with bonds. The other way, of course, is to say to the market that unless you have an interest in the underlying bond that you're trading in, you can't use a credit derivative. But that would be quite an extreme step from where we are now.
That would kill the speculation stone dead.
It would certainly make it a much quieter market than the one we've had over the last 5 years, yeah.
Big government regulation like that certainly wouldn't be popular with the credit default swap industry. But with taxpayers' money funding the massive banking bailout, it's not just a private matter anymore.
Alex Whitson there. Right, now let's try and...